Most people are not ready for the crypto bull market we are entering into. With both Bitcoin and Ethereum recently breaking all-time highs, the market is flashing even stronger signals that it's about to erupt. But here's the part that almost nobody is ready for. This cycle is turning out to be unlike anything we've ever seen before. The rotation from Bitcoin into Ethereum has already begun, and for the first time, companies and funds are building treasuries not just for BTC, but also for altcoins like Solana, XRP, and even Dogecoin. Every indicator is flashing that the most explosive stage of the cycle has begun, and if history is any guide, the months ahead could deliver gains that shock even veteran investors. In this video, I'm going to break down why this bull market is moving faster than expected, how the 4-year cycle lines up with past blow-off tops, what new adoption trends mean for altcoins, and why this run could push crypto valuations to levels nobody thought were even possible. Before we jump into it, just a quick reminder, only a small percentage of you watching are actually subscribed. If you find these breakdowns valuable, make sure to hit that subscribe button. It's free, it helps the channel, and you can always change your mind later. Now, let's get right into it. After hitting a new all-time high of 124,000, Bitcoin has now pulled back to just under. The drop dented confidence in the short term, but the overall market structure remains intact. On the charts, the price has retraced sharply and then settled into a consolidation range, still well above 6 figures. It looks less like exhaustion and more like the kind of pullback that often resets the market before continuation. As long as Bitcoin holds this support zone, the technical setup remains strong. Now, what makes this pullback unique is the context in which it happened. The correction came as President Donald Trump announced a $12.2 trillion crypto policy that could change capital markets in a way no previous administration has attempted. At the same time, JP Morgan flipped its view on the Federal Reserve, raising expectations that liquidity conditions could shift faster than expected. Banking groups tied to JP Morgan and Bank of America also warned Congress that the Genius Act stablecoin bill contains a loophole that might allow issuers to offer yields, potentially sparking trillions in deposit outflows from traditional banks. These headlines fueled volatility and wiped out $250 billion from the wider crypto market in just a week. But even with these shocks, Bitcoin's position above $113,000 shows the long-term trend is still firmly in place. Ethereum still trades below its old highs and looks undervalued in comparison, with the EDS Bitcoin chart already bouncing from the bottom. If Bitcoin steadies here and resumes its climb, its setup for a run toward 200,000 remains alive. That kind of move would not just drive Bitcoin higher, but open the door for Ethereum and other assets to climb sharply as confidence spreads through the market. Now, to understand how the timing of these moves could play out, it helps to look at crypto's seasonal patterns, which have repeated across every cycle. Seasonal patterns in crypto give us one of the clearest roadmaps for what happens next. When you study past cycles, the same months keep standing out. Most days in August tend to lean positive, while September has almost always delivered negative returns. In fact, every post-halving year on record has delivered a red September. In 2017, Bitcoin dropped more than 20% that month, and in 2021, it lost over 13%. Those pullbacks shook confidence at the time, but both led directly into massive fourth-quarter rallies. Ethereum has its own track record. Historically, it outperforms Bitcoin in the middle stretch of the cycle. May, July, and August have produced some of its biggest monthly gains, and we are seeing that play out again now. The ETH Bitcoin chart shows momentum shifting toward Ethereum, which matches the seasonal data. That doesn't mean September will be easy, but it does suggest that a strong recovery could follow. October through December is where the real action usually happens. In 2017, those months combined for more than 150% gains in Bitcoin, and Ethereum ran even higher. In 2021, the returns were smaller but still significant, with Bitcoin adding 43% in October before peaking in November. The important takeaway is that September tends to be the shakeout month, not the end of the cycle. Right now, the seasonal picture points to the same setup. Expect turbulence in September, but also expect that the final 3 months of the year could carry the strongest upside of the entire bull market. Now, the 4-year cycle remains the most useful framework in crypto. Every halving cuts new Bitcoin supply in half, and every cycle since 2012 has followed a similar pattern. Prices rise gradually after the halving, momentum builds in the second year, and then the final stage delivers the steepest gains before a major reset. Right now, we are in that final stage, but if you line up the current market with past cycles, it becomes clear we are running slightly ahead of schedule. In 2013, the big rally didn't arrive until late in the year. In 2017, the same thing happened, with the vertical surge starting around October. By comparison, 2025 is already pushing higher earlier in the calendar. That doesn't mean the cycle is broken. It means that institutional adoption and new inflows could be accelerating the timeline. It's also worth remembering that 2021 had its own anomaly. That cycle experienced a 50% correction before exploding into a new all-time high. The current market has not seen anything on that scale, which suggests either a pullback is still possible or the market is simply stronger this time around. What remains consistent is the tendency for the largest rallies to cluster toward the end of the halving cycle. Investors don't need to predict the exact day of the top to benefit from this structure. The key is recognizing that we are in the zone where the biggest moves tend to occur. Whether the final push comes in October or stretches into early 2026, the setup shows that this is a window where crypto delivers its largest gains. Now, one of the biggest differences in this cycle compared to any before it is the level of institutional adoption. In the past, Bitcoin was mainly driven by retail investors and a handful of crypto-native funds. Today, the largest financial firms in the world are building direct exposure. Charles Schwab, which manages trillions in client assets, has confirmed plans to open Bitcoin and Ethereum trading to retail customers. Standard Chartered is setting up institutional desks for the same assets. Moves like this change the market because they allow both individual investors and massive institutions to enter through trusted, regulated channels. ETFs are another major driver. Bitcoin spot ETFs are already pulling in billions of dollars in inflows, and BlackRock has recently revised its Ethereum ETF application to include staking. That change would let investors earn yield directly through a regulated product, something the SEC initially blocked. If approved, it gives Ethereum a stronger investment case for institutions that are looking for returns on top of price appreciation. Corporate treasuries are also evolving. MicroStrategy proved that companies could raise capital, buy Bitcoin, and turn their balance sheets into growth machines. Now others are taking the same idea and applying it to Ethereum, Solana, and even XRP. Firms are issuing stock or bonds and channeling the proceeds into crypto reserves. This signals a shift in how digital assets are viewed, moving from speculation to strategic balance sheet assets. Institutional adoption creates constant demand, backed by deep pools of capital. That demand doesn't vanish during corrections, and it keeps building new floors for price. The higher that base gets, the stronger the setup for the next wave upward. Adoption is no longer limited to the US. Around the world, governments, banks, and even cities are starting to integrate crypto into daily financial life. In Australia, banks have begun issuing Bitcoin-backed mortgages. That means homeowners can use their Bitcoin as collateral instead of selling it, unlocking traditional financing while keeping exposure to the asset. In the United States, Bitcoin-backed loans have already crossed the billion-dollar mark. That shows people are willing to treat Bitcoin as collateral in the same way they would treat real estate or equities. Local governments are also stepping in. A US city recently became the first to mine Bitcoin as part of its financial strategy. If one city finds success, others will likely follow, creating a domino effect across municipalities looking for new revenue streams. Global banks are joining the movement too. Standard Chartered is opening Bitcoin and Ethereum trading to its institutional clients. More banks are expected to follow, and eventually these products will filter down to retail customers. When the average investor can buy Bitcoin directly from their bank account, the barrier to entry disappears and the pool of buyers expands dramatically. These developments matter because they increase demand while also normalizing crypto. Mortgages, loans, municipal mining, and banking products all create real-world use cases. That mix of financial innovation and adoption is unique to this cycle. Each move builds pressure, pushing crypto deeper into the global financial system. Once that integration reaches critical mass, the growth curve becomes much harder to stop. One of the most surprising trends of this cycle is the rise of altcoin treasuries. In past bull markets, only Bitcoin was treated as a serious corporate reserve asset. Ethereum came later as a secondary option. This time, companies and funds are expanding beyond those two. We are now seeing dedicated treasuries for Solana, XRP, BNB, Litecoin, and even Dogecoin. Firms are raising hundreds of millions of dollars through stock offerings or bond sales, then turning around and allocating that capital into specific altcoins. This is not a gimmick, it's an extension of the same logic that pushed Bitcoin treasuries into the mainstream. Once companies like MicroStrategy proved that holding Bitcoin could create shareholder value, it opened the door for others to try the same strategy with different assets. Some of these bets will succeed and some won't, but the key point is that the practice has gone mainstream. The scale of this trend could become enormous. There are thousands of publicly traded companies worldwide, and many have the ability to raise capital specifically for treasury strategies. If even a small percentage of them follow through, the amount of money flowing into altcoins could dwarf anything we've seen before. That doesn't mean every project will survive, but it does mean liquidity will be deeper and valuations can spike much higher in the short term. For investors, altcoin treasuries change the structure of the market. They provide demand that doesn't vanish overnight, and they bring legitimacy to assets that were once dismissed as pure speculation. This shift could be one of the main reasons why the current bull market shocks people with how far it goes. Every bull market brings massive opportunities, but none come without risk. The first thing investors should prepare for is volatility. Bitcoin may be getting steadier now, but history shows corrections are part of the game. September has been the weakest month of the year in every post-halving cycle. In 2017, Bitcoin fell more than 20% in September before roaring into a new all-time high. In 2021, the drop was more than 13%. Pullbacks like these are not unusual, and they shake out over-leveraged traders and reset the market before the next run. Overextension is another risk. The current cycle is moving faster than past ones, and that raises the possibility of sharp retracements. If price action has advanced too far too quickly, corrections can be deeper than expected. Long-term investors should keep that in mind and avoid chasing vertical moves without a plan. There's also the psychological side. Many investors panic during corrections, selling at the bottom only to watch the market recover. The real danger is not the pullback itself, but missing the explosive months that follow because fear forced you out. Past cycles have shown that missing the final stage of the rally costs far more than enduring temporary drawdowns. The best approach is balance. Some investors take partial profits along the way to reduce stress while keeping a strong position for the upside that usually defines the end of the cycle. The key is not predicting the exact top, but staying in the market long enough to capture the big moves. In crypto, discipline often matters more than timing. This bull market is already proving different from anything that came before it. Bitcoin is regaining stability after its recent pullback and continues to hold strong. Ethereum is showing signs of a powerful rotation, and altcoins are preparing for their turn. Seasonal patterns suggest September could bring turbulence, but history shows that the strongest gains usually come right after. The 4-year cycle also points to this period as the window where the biggest moves usually happen. The setup is here for one of the most shocking bull markets in crypto history. Investors who stay positioned through the volatility will have the best chance of capturing what comes next. But to stay ahead of every major move, you need the right information. My daily 5-minute crypto newsletter delivers expert predictions, breaking news, and on-chain analysis straight to your inbox. It's already trusted by more than 90,000 readers who want clear, reliable updates on Bitcoin and the wider crypto market. Don't miss out on the opportunity to stay informed in the crypto market. The link is in the description below. Anyway, guys, I hope you all enjoyed today's video and that it gave you some value. I'll see you all at the next one, and as always, all the best.